Welcome to the Bosses Building Bosses Inspired to Empower Masterclass Volume 3. This masterclass is going to be covering aspects as it relates to financial management in small business. As customary, we're going to look at the objectives for this video course. The first objective is to provide a simple, comprehensive perspective on managing your finances in your small business. The second objective is to create a critical thinking mindset in understanding and implementing the concepts covered within your small business. And the third objective is to motivate participants and guide them in the right direction to financial freedom in business. Without further ado, let us begin with what is financial management. Financial management means planning, organizing, directing, controlling the financial activities such as procurement and utilization of funds of the enterprise. It means applying general management principles to financial resources of the enterprise. Investment decision includes investment in fixed assets. Fixed assets are items that you own in your business. So for example, machinery, cash and cash equivalents, cash, physical money, and things that can be converted into cash, such as a piece of equipment or a piece of machinery, land, a building and materials, a computer, a printer, and things of that nature. These are considered to be assets and can be further categorized into fixed assets and current assets. So really, financial management involves planning, it involves organizing, directing, controlling your financial activities. When we speak of financial decisions, they relate to the raising of finance from various resources which will depend upon decision on type of source, period of financing, cost of financing, and the returns thereby. There's also a scope of financial management known as dividend decision, which has to take decisions, or whoever is responsible for taking these decisions have to take such decisions with regards to the net profit distribution. Let us now look at the benefits of financial management. Quality financial management offers many benefits to you as a business owner. Financial management includes bookkeeping, projections, financial statements, and financing, which forms the foundation for reaching your goals through sound business decisions. Financial management is one of your main avenues to success as a business owner. So being able and having the mindset to want to learn, or if you're already capable and you feel you're comfortable in managing your finances when it comes to your business, that is a very important avenue as a business owner that you should take. Financial management is the way you know if you are making profit in your business. So being able to manage your money or manage your business cash, your money coming in from what you sell, what you make, what you spend, being able to manage those concepts is what will determine whether you make a profit or a loss in your business. Financial management helps you decide what you can afford in terms of store or office location, inventory purchases, who to hire, and what equipment to buy. You need sound financial information to set your prices and select your vendors. Financial management gives you the tools to plan for overall business growth, for diversification of your product lines, or for reaching new markets. Financial management also helps you decide which products, which services, which markets are going to be profitable. Effective financial management gives you tools to chart your course into the future, adjust your direction when needed, and help you find your way through challenging times. So in this slide, you can see the different benefits of financial management, which includes it being one of the main avenues to your success, as I said earlier. It affords you the opportunity to be aware of your profit. It helps you make sound decisions. It gives you tools and resources that you can use to further develop your business and to manage your monies. It provides you with adequate or much needed information that will help guide you along your financial management journey in your business endeavors. And it also helps you effectively discuss your business in terms of when you are applying for a loan or when you are even pitching your business to potential investors. If your business growth requires financing, financial management provides information to know how much you can afford for your business. Financial management gives you not only the documentation needed for a loan application, but also helps you discuss your business circumstances with a lender in terms that improve your ability to qualify for that loan. Later on in this class, we will look at the different types of loan and the different things that lenders or financial institutions would require from you as a small business owner in order for you to qualify for that loan. Next, we're going to look at budgeting. Now, budgeting really is a list of all your monthly or yearly expenses organized by categories. Creating a budget is the first place to start with your financial management practice. A budget is a list of all your monthly or yearly expenses, as I just mentioned, organized by categories. Now, using a budgeting tool helps you with the following. It helps you track all your business expenses. It helps you plan, economize when you need to, plan for expansion, make a profit, control your spending, and it also helps you to reduce any business risk that may come along during your business endeavors. As you can see in this slide, I just gave you a simple sample business budget that you can use, especially if you're just starting off, or if you are already in business but you're a small entrepreneur and you're not really interested right now in any accounting software or anything fancy, then this sample business budget will help you, especially if you are new to budgeting and you're not sure where to start. Then you can start with something like this. So basically what it is, it's as we said earlier, what budgeting is categorizing the different expenses that your business has, and whether you record your expenses on a monthly basis or whether you record your expenses every year. So under categories, we have some examples. You can get this in a editable version if you are interested, in a Word version so that you can just plug it in, or you can simply print it out, but I would advise to have it in an editable version where you can just edit it on the computer itself, because some of the categories may not be applicable to your business at this time. So for example, there are categories such as rent, utilities, insurance, office supplies, inventory, and the list goes on. Based on your current business expenses, then you will remove and add as necessary, as needed. The next column shows the monthly budget and the one after shows the actual monthly expenditures. So what you would do in a case like that, you would, for example, for your utilities, if you want to have subcategories for utilities, which would be your main category, so you would put utilities, then you may have a subcategory, for example, electricity. Then you can put a monthly budget of what you think your electricity would be for the ending of. So what you think you might pay, you may go based off of what you usually pay every month. It may be fixed or it may be varied. So you can put a monthly budget, and then when you actually get the bill and you pay it, or when you actually get the exact amount, then you would put it in the column which says actual monthly expenditure. So this sample business budget is very user friendly, especially if you have a small business or you're just starting off and you want to learn how to do budgeting or to start managing your finances and get into doing budgeting for your finances. This is a very good sample that you can utilize, as well as there are obviously others out there available that you can do your own research on. Next, we're going to look at some steps to follow when creating a business budget. There are so many small businesses that are started and failed within the first year of operation. There are many reasons why a small business fails. Failure can be due to bad marketing, not having a well-designed strategy, bad pricing, a poorly developed product, and many other reasons. One of the most common reasons is making a bad business budget. Creating a business budget for your business is very important if you look forward for a successful business. A budget keeps your finances under control so that you do not overspend and place your business in debt. Debt can be hard to get rid of, especially if you do not generate the cash flow to get out of debt quickly. There are also many other reasons why your business needs a budget, which includes minimizing unexpected cash flow issues, controlling spending, better informed decision in other departments, assisting with financial applications, informed financial targets for department leaders, and risk reduction. So the first step to follow when creating a business budget is looking at your research costs. You need to research your costs so that you are not caught off guard when making those unexpected expenses. Not only the unexpected cost sets you off track, they make it hard, very hard for you to accomplish your goals. If your budget was set for a certain cost and you later determine that more money would be needed, you now have to reduce the profit being made on your sales. This puts your business in a bad position because you now have to determine how you will increase both revenue and profit to offset the high expenses. So researching the different costs that would have to go into your products, or into purchasing your products, or into production if you're doing manufacturing is very important. When operating a business, your budget will need to be created to account for fixed and variable costs. Fixed costs include your rent, your utilities, your phone, internet, legal fees, salaries, advertising and marketing, etc. Variable costs would include costs of your goods sold, labor, or commissions. The next step is project revenues. Now, calculating how much money will be generated from your sales activities on a monthly, quarterly, and yearly time frame is a must if you want your business to be successful. So many failed businesses occur due to not calculating revenue, or they overestimate their revenue and increase their costs that was initially estimated. This is why it is very, very important to follow certain tips or certain steps when doing your revenue projections. For example, using conservative revenue estimates. Do not project generating thousands and thousands of dollars in your first year of business. Hey, even in your first 6 months of business, especially without having an established customer base. So for me, for example, I have been in business for about a year and 8 months, almost 2 years, but not actively in business. The business has been registered for about 6 months now. When I'm doing my revenue projections, or estimating how much that I want to make in the next year, I don't go overboard, because I haven't reached that stage yet where I have established my customer base, and there are different things that haven't been put in place or I haven't perfected as yet. So when you're doing your projects, your revenue projections, do not over project, especially if you haven't got certain things that are mandatory and that are necessary. If you haven't got them established and down as yet, then it's safer to not over project. Another tip when projecting your revenue is using your previous year's figures as a starting point. If you make $100,000 in revenue, or if you made $100,000 in revenue in the previous year, an estimate of, let's say, 200,000 would be safer, or even 150 would be safer, would be a safer projection to make if you expect growth of your business, or if you expect growth to occur. The important thing about revenue projection is that you base your projection on facts, on real data, on actual figures. You cannot create projections based on revenue you would like to bring in without having a system in place to support your goals. So you have to be realistic when you're setting your goals. You cannot create a goal for yourself, even for your business, that it's not realistic, that you know is not attainable, that's not going to be attainable at this point in time in your business career. So say, for example, I want to save $5,000 by December 31st. If you know your situation will not permit you to save $5,000, you know it's not going to happen unless there is a miracle or you win the lottery, then don't set a goal in that regard. Be realistic. If you feel more saving $1,000 by December 31st, 2020 is going to be more realistic or more attainable, then set that goal, working towards the $5,000 goal. But do not prematurely set a goal that you know is not going to be realistic and is not going to be attainable because of a certain situation that you're in, or your business is not at that point. So that is very important when you're projecting your revenue. Base your projections on real data. You cannot create projections based on revenues that you would like, as I said before, without having a solid system in place to support that goal that you're trying to achieve. You need to base your projections upon the capabilities of your business, what your business can afford, what your business can do, how your business can reach to that point. Is your business in a position to reach to that point? If you were $1 million business last year, it will be very hard for you to be $100 million business in just 1 year. Therefore, base your projections upon realistic growth that will occur over time. The next step that you can follow when creating your business budget is to figure out or determine your gross margin profit. So your gross margin profit indicates the financial health of your business. Gross margin profit is the money left over after your cost of doing business has been paid for. So for example, your business could generate $1,000 in revenue but not be in debt at the end of the year because your expenses exceeded the revenue you generated. This happens because you do not know how much you are spending to operate your business. You could be wasting money on products and services that have no effect on your business beyond costing you money. Therefore, you need to analyze your business operations in an entirety to discover where expenses can be eliminated. So, to give you some advice on how to improve your gross profit margin, you can list all costs of goods sold. So whatever it is that you sell, you can do a simple list and jot down next to it what was the cost to sell, what did it cost you to sell these goods. You can also subtract the cost from the overall sales revenue that you make. So you can subtract individual costs from the gross, from the entire revenue that you made, whether it's on that particular week, or you can do it quarterly, monthly, whatever you choose, whatever method that you're comfortable with. You can also consider entire business versus individual departments, but that may be relatable to larger businesses. When small businesses, more or less the entrepreneur alone, or if they have one person working with them. When you follow these steps, you give yourself real insight of how well your business is doing. Now you have the information that is needed to increase your profits while reducing your costs at the same time. This allows you to develop a business that is actually successful rather than just appearing successful to large sales volumes. So it's good to actually know what your figures are and know what your profit is, instead of just having an appearance of making money. You're selling, so your sales, you're selling every day, you're selling, so I'm making money. It's always good to know for a fact what your figures are and to work towards, achieving that certain business growth or that level at which you want to reach with your sales and your business. Another step when doing your budget is to adjust for that's supposed to be debtors, not creditors, but adjust for unreliable payers. So unfortunately, you will have to deal with customers who make payments beyond the stated terms of the invoice. This affects your cash flow projections because missed payments lead to no cash flow in your business. These missed payments actually throws everything off because you have your own expenses to pay, and missed payments make you late on your own payments due to your service providers. Knowing that you will have to deal with unreliable players, you need to create a plan that effectively deals with these types of customers and in these types of situations, because you really don't know when these types of situations are going to occur. So you need to prepare for them and you need to plan for them accordingly. Although there will be times when a customer cannot make a payment due to their own personal financial issues, it should not become a habit. Once it becomes habitual, though, that is a customer you need to fire because they are taking advantage of your leniency. If you do not initiate a plan that keeps these troubled customers under control, you will find yourself out of business due to their bad payment behaviors. And there are some ways that you can deal with customers that fall into that category. You can allow for late payments. You can allow for bad debts, which really means that you need to have an amount set aside for how much debt will be allowed to occur based upon payments not being made at all. So it's like you need to cover your tracks in the event that happens. And you can also create business policies to deal with late payments. Policies are always good to create when you're in business, as small as you may be. Policies is really guidelines or rules that are made privy to your customers that will help them know what and what not to do when it comes to payments, when it comes to purchasing, when it comes to payment plans. If you can pay now, different things like that. Policies in general are always useful, especially in business. You can also adjust for high and low times. If your business has periods where it is very busy and then periods where it drastically slows down, you will need to account for these cycles in your budget. You cannot continue to spend money as if it is being generated every single month, because there will be times when you're not selling as normal. One month you sell a lot, one month you're not selling anything, one here, one over there, so it happens. Doing so will deplete the cash you earned and put your business at serious risk of shutting down. Therefore, you will need to find ways to offset your slow periods by implementing procedures that help you retain the money that you have earned. This can be accomplished by doing things such as researching the seasonal demand for your industry thoroughly, in depth. So researching when are the high times, if it's during Carnival or during Christmas or during Independence, creating savings at peak periods to cover quiet months, allowing for temporary staff if required and if it meets the demand for the product or the service. Another step is deciding how to spend. The way you spend is a major indicator of how well you will maintain budget. If you are spending money frivolously on the things that do not help to grow your business, then you are wasting money that could be spent in better ways. For example, spending a lot of money on new furniture does not bring revenue back into your business and is a waste of money, especially if you are small. Let's say, for example, you are a hairdresser or you do nails and you have a location in town. It is useless to purchase things that you don't need. If you really need a piece of furniture, then that's a different thing. But if it's something that you will buy eventually, but it can be held off until you make a certain amount or until you put that in your budget for new furniture, then that's what you do. But it can wait. Certain things can wait. So deciding how to spend, knowing when to spend, how to spend, and how to budget for what things that you want to spend on for your business. On the other hand, increasing the spending of your marketing campaign because it has been creating more leads for your business is a great investment. So there are certain things that you can invest in, even if it may not be seen as a direct need, but things such as marketing for your business on Facebook, when you do the promotions on Instagram and the different social media platforms, is something that it may not be a direct need, but it is creating a positive effect for your business, or it's creating a turnover that will positively affect your business in the short or long term. Then that is something that you can spend on. Deciding how to spend is very important. You will have to learn what type of spending is best for your business that will help in the long run. And it's very important to know when to spend and what you're spending for and how it can impact your business in the long run, not just thinking of right now and I need it now and it looks nice and it's something that will look nice in my beauty shop. No, you have to really internalize and really decide whether it's a necessary spend. The next step when creating your business budget is to discuss your costs with suppliers. Try to negotiate deals with your suppliers that will allow you to get the materials and services you need at a discount or before you make a payment. You will have a lot of money going in and out of your business, and sometimes you will not have the cash on hand to pay your suppliers for their services. This is why you need to create an arrangement that benefits both you and your supplier. For example, you could get the services up front and pay a little more for the advancement when you have cash on hand. You could also negotiate for a discount based on the quantity of supply you purchase. Whatever you choose to do, you need to find ways to reduce your costs of doing business so that you can incur more money, you can make more money. Another step is to discuss expenses with your team. Everyone within your business needs to be aware, or if it's just you need to be aware of the budget your company needs to maintain or your business needs to maintain. This helps you focus on reducing spending while increasing performance to generate more money. A lot of times your budget will be overspent because it has not been discussed with your managers. When it is communicated that costs have to be maintained at a certain level to keep the company profitable, people will take notice of what needs to be done and plan accordingly. So if you have a team, then you communicate your cost that you want to maintain to a certain level. If it's just you, then you have to be knowledgeable of what cost you want to maintain. Another step that is important when you're preparing your business budget is to know when to invest. You need to focus on spending that will promote the growth of your business, whether it's on training for yourself or if you have a team member or someone helping you, training for them in a certain area, purchasing new software, or hiring a consultant or business advisor. Money being spent should bring a return to your business. It should benefit your business in some way. So if you're spending for Girls with Goals 767 to do marketing consulting for you or to manage your marketing, then that should do something for your business. That should generate more leads, that should bring in more traffic. Therefore, you will need to prioritize what type of spending will be the best option when making a decision. You may have to determine whether your budget being spent on short-term investments or long-term investments. These type of decisions can be tough depending on your current needs. What is important is that you make a decision that will lead to strong profitability and growth for your business. If this is not a factor within your decision making, you are probably making the wrong decision. Another step we can look at is creating a backup plan or a contingency plan. If your business deals with some type of setback, such as a large loss of customers or a lawsuit, you will need to have a plan already in place to deal with these losses, to deal with losses in general. Hopefully your setbacks will not be this severe, but you do need to have a plan developed to deal with financial setbacks that will affect your projected revenue and profit. COVID-19, other pandemics, natural disasters, these are losses that are realistic to us and that we face as business owners, especially if you have a physical location or if you're providing a service that you have to go out or you have to meet people or you have to do field work. So you need to have a backup plan in the event that things happen. Just as my friend would say in her advice, in the financial advising, you need to have an emergency fund. In business, it is always important to have a contingency plan. This is why you have a savings plan within your budget so that you can operate during rainy days. Without this type of planning already drawn out, you cannot keep moving forward because you are blindsided by problems that impact the ability for your business to continue. And last but not least, review your budget regularly. When you create your budget, it should be reviewed as often as possible so that you are keeping track of your progress. Don't just create the budget and toss it on a side. Always go back to it, change things as your business grows. Many businesses do not keep their spending within their set budget because they just write the budget and put it away, only to review it when their business is dealing with some financial difficulties. As a business, you have to be proactive rather than being reactive. The best way you remain proactive with your budget is by reviewing it often and making the necessary adjustments to your budget when it is required. When you prepare your budget, you must always revisit it and do necessary adjustments, addition, subtraction when it's necessary. Don't just start doing the budget or do a budget for your business and then just toss it on aside and forget about it and go back to it when something happens or when you're in a financial hurdle. You can do quarterly budget reviews, which allows flexibility. You can adjust your figures. You can speak to an accountant if you have one or a business consultant like myself. Make sure all relevant people in your business can see figures in real time to influence their decision. Ask for costs or benefit analysis with all requests from departments. That's more or less for bigger businesses. Track your financial performance against projected or against forecast financial performance, and monitor processes for opportunity to effectively cut costs. Now we're going to take a look at bookkeeping. Bookkeeping is the organized process of tracking all income and expense transactions. Bookkeeping is a critical component of financial management, which leads to better business decisions regarding financing, taxes, owner's draw, and retirement. So there are some basic bookkeeping steps that you can follow or that can guide you if you're already practicing bookkeeping, or if you're wanting to start a business, you haven't started yet, and you want to incorporate bookkeeping in your business processes. The first one is to obtain a business accounting software. Proper software selection is critical for success. There are different business accounting softwares out there, such as QuickBooks, Sage, Wave Financial, etc. What I can recommend is that if you're just starting, you may not, and you're not too familiar with accounting softwares, and you don't necessarily want to go through all that. There is a single bookkeeping, and there is double bookkeeping, which we'll look at in a little while. So there is a simpler form that you can use, but bookkeeping is really record keeping of your financial transactions, cash going in, cash going out. But as your business grows, there are different areas of bookkeeping that you can visit and that you can look into based on the level or the stage at which your business is. Next, you obtain a separate business bank account or a separate credit card or separate debit card apart from your personal. Do not mix business and personal. I believe it's not wise, and I would recommend to keep things separate. For me, I have my personal bank accounts and cards and checking accounts, as well as business checking accounts and debit cards. So whatever income that is generated for any service that I offer would go directly to a specific account. I like to see my finances, things in general, organized, and I don't want to mix my personal money with my business money, things like that. So it's always a good approach to have a business account, Girls Equals 767 account, or whatever business you have. Or if you don't have a business as yet and you're thinking of starting a business, it's always wise to have to set up a business account. The third thing is to reconcile your checking account. Each month, reconcile your account using business accounting software or a cloud reconciliation process. You can also track sales. That's another step when you're doing basic bookkeeping. Create a airtight system, a system that is suited to you and that you're comfortable with for tracking sales using tools such as invoices or a sales book. So you can have a book. Whenever you sell something, simple. Whenever you sell something, you just record it. So for example, if I did the logo for someone or for a business, a client, if I were to record my transactions like that using a sales book or a log or whatever you want to call it, I would just write logo design for such and such a company, $100. Simple thing. I can put the date, I can put paid, if I issued a receipt number and things like that. It's just a way of tracking your spending, tracking the money that is coming in and money that you're spending for the business. Another basic bookkeeping step that you can look at is depositing all your sales using the deposit slip, the duplicating deposit slips, so it has like a carbon pad, so when you fill it out, it keeps like a carbon copy. Deposit all sales in your business account, whether it's a business check-ins or you just have a regular savings business account savings. Your total sales should equal your total deposits. So if I did 5 logos for the week and I made $500, I should deposit $500. Do not spend cash sales. Link all forms of sales documentation, such as your invoices, if you have a cash register tape, or if you have a sales book, with a specific deposit. So if you're doing single deposits, like I did a logo today, I got $100 and I'm going to deposit it to the bank today, then I would link whatever entry that I put in my sales book or whatever bookkeeping method that I'm using, I would link it to my deposit slip. So, you know, like when you deposit, they give you, for example, National Bank gives you this blue paper, tells you how much you deposited. Then you can just put a note at the top, or you can, whatever way you want to link it with your entry in your sales book. That's basically what it means. You can write checks for all business transactions, as if you have a checking account. Obtain a separate business credit or debit card. We said that earlier. You can pay your business expenses first. Most businesses start out as sole proprietorship. In sole proprietorships, you, the owner, do not get a salary. Rather, you take an owner's draw. A common question is how much draw to take. Here's a rule of thumb. Sales pays for business expenses first, personal expenses second. And we will look at paying yourself in a little while, which would link to paying the business expenses first. So let me repeat that. Sales pays for business expenses first. So whatever you sell, that pays for your expenses of your business first. Personal expenses second. Personal expenses meaning your draw. So it's not really some of us call it a salary. We pay ourselves. So if we're working for ourselves, we're entrepreneurs. We pay ourselves. Some of us call it that's our salary. But really it's called the owner's draw. And you can always research that and get more information online. I'm sure there's much more information as to what owner's draw is. But it's really paying your business expenses from what you sell and after paying yourself. Now we're looking at paying yourself. Let's look at profit and loss statement first, and then we'll look at paying yourself. So a checking account balance is not a good indication of how much profit the business has made or what amount is available for owner's draw. A profit and loss statement can provide a better picture of the financial health of the organization. Now we're going to look at pay yourself with owner's draw. Owners should pay themselves by writing a check or making an electronic transfer from the business account to a personal account. So if you don't have a business checking account, you can just do a simple transfer, or if you rather deal with cash, you can just take cash out, that whatever amount for yourself. If you are a sole proprietor, assign those checks to an equity account called draws, but that's going more in depth. If you're just keeping it simple, you can just record it. It's just simply having a record. Bookkeeping is having a record of everything that you do within your business when it relates to money. So bookkeeping is really recording financial transactions in a systematic way, in an analytical way, and it's really the basis or the foundation of the accounting system. Now, as I was speaking on earlier, there is 2 types of bookkeeping systems. There you can use the double entry system or the single entry bookkeeping system, sorry. So this is a simple and easy way to record money going in and money going out. It's a simple debit credit, debit money coming in, credit money going out. There is low volumes of transactions. It's a cash accounting concept. There is no recording of inventory, no recording of trade payables, assets, liabilities, none of that. It's just a simple recording of who you pay and who pays you. Double entry system, it's more popular. It's more practical. There is an accrual accounting system concept. It is able to track your inventory, your assets, your trade receivables, your trade payables, your liabilities. It's more complex and it provides greater details for financial statements. So the single entry system is an only income and expense account. So money coming in, money going out, and that's it. For the double entry system, it requires recording each transaction twice using debits and credits. Now this table that I have included here shows a more explanatory version of what the double and single entry system is. So the basis of the double entry system is it's based on principles. The single entry is not based on any principles. As I said before, the single entry is just income and expense, recording income and expense. That's all. It doesn't take a look at your liabilities, what you own, what you owe, trade payables, none of that. It's just recording money coming in, recording money going out. However, the basis for the double entry system is more related to accounting principles. The aspect of the single entry system is both the aspects of a transaction are not recorded. For the double entry, both are recorded. Accounts maintained. For the single entry system, usually cash and personal accounts are maintained. And for the double entry system, all types of accounts, real, personal, nominal, are maintained. Utility. For the single entry system, it's useful for small traders or small businesses. For double entry, it's useful for all types. So the small businesses would more gravitate towards using the single entry bookkeeping system, but the double entry is more versatile. That means that both small and large enterprises or businesses can use it. And for the financial position of the single entry system, it's an estimated financial statement is ascertained. And for the double entry system, true and fair financial statement is ascertained because it goes more in depth. It covers more financial aspects in your business as opposed to the single entry system, which just records income and expenditure. So it's more of an estimated financial statement as opposed to using the double entry method, which will give you a more accurate. Now let us look at the accounting equation. The accounting equation really means that your assets equals your liabilities plus your equity. Assets is what you own, liabilities are what you owe, and equity is what's in it for you. So assets would include your cash in bank, your computer, your desk, your car, your inventories, customers who still owe you, your debtors. What you owe would be your creditors, loans that you're paying, bills that you still owe, tax payables. And your equity is profits or loss, your profits or your losses. So your assets, anything of monetary value owned by a person or a business, liabilities, amounts owed by a business at any one time, and how much someone gets paid for selling something they own is that person's equity or shareholders' equity. Now we're going to take a look at cash flow. Now cash flow can be defined in two ways. Balance of cash received less the amount of cash paid over a period of time, and moving cash in or out of your business. A cash flow projection is a financial statement that tries to show how cash is expected to flow in and out of a business over a future period of time. A cash flow projection is used to see if projected cash receipts will be sufficient to cover projected cash disbursements. So the inflows would be your receipts and the outflows would be your disbursements. A business can be profitable and still run out of cash. Yep. As an investment banker might say, cash flow projections provide the visibility needed to avoid liquidity problems. In other words, a cash flow projection is a tool to help you manage your cash so you can pay your bills on time and keep the doors of your business open. So as you can see, there is good cash flow and there is poor cash flow. So good cash flow, paying your bills on time, paying your employees on time. Good cash flow, the ability to plan for the future of your business and for your future as well. Poor cash flow is always chasing debtors, little ability to plan, and insecurity for your employees and creditors, not being able to pay your bills, always have to take out a loan, going into overdraft, etc. A cash flow projection is a great tool for setting sales goals and for planning for expenses to support those sales. A related use for a projection is to determine your break-even point during a startup or expansion phase. If you need to plan for a large expense, such as an equipment purchase or a new location, a cash flow projection is perfect. It's a perfect tool. Similarly, if you have a seasonal business with large inventory purchases, a projection can help you have the cash on hand to make a large inventory investment when you need it. So now we're going to look at strategies for creating a positive cash flow. As listed here, you can see that it increases the number of items sold, it increases the price of these items, it reduces expenses, changes the timing of expenses, saves you money to have sufficient cash to get through your startup phase, obtain sources of cash streams other than what you sell or money that you get from your sales, reduces or changes the timing of your owner's draw. That's not on this slide, but that is another strategy. Research vendor buying options and establish policies to get paid sooner from customers that owe you. So as you can see here, I included a sample cash flow projection that you can use, and I can provide you with the editable version also, and you can use it to create your own cash flow projection for your business. So let's look at this sample. The first set of rows, I hope you can see, which is titled Sources of Cash. It documents all sources of incoming cash, including cash from your customer sales, interest earned, loan funds, current check-ins and saving accounts balances. The second section, which is titled Operating Uses of Cash, contains all those expenditures associated with the day-to-day buying and selling process. Most of these expenses show up on the profit and loss statement. The third section, which is non-operating uses of cash, shows expenses that normally show up on the balance sheet: purchasing an equipment, principal portion of loan payments, taxes, inventory, owner's draw. Subtract your uses of cash from your total cash available and you have ending cash for the month. Ending cash for 1 month becomes opening cash for the next month. So your balance at the end of a month becomes the balance that you bring forward to the next month. There are different ways that you can finance your small business, such as equity financing, debt financing, working capital, and fixed asset financing. The first one is equity financing, invested funds that stay in the business, often permanently. For most small businesses, equity comes from the owner or from family savings and is frequently the only source of funds for startup small businesses. For large, fast-growing businesses, venture capital can sometimes be accessed for equity. Another core element in business financing is debt financing, which is borrowed funds that are paid back. The cost of debt financing is interest paid to the lender. Working capital is the next one. The money that is used to pay for the daily operations of the business incurred in short term, such as inventory and overhead expenses. And last but not least, fixed asset financing, which is used for purchasing equipment, purchasing vehicle, or purchasing real estate. Now we're going to look at some do's and don'ts for small business financing. The first one is investing your own money. You need to invest your own money first before you ask for equity or debt. Before you take out a loan, especially if you're small, it's good to invest your own money, as little as it may be. Having your skin in the game shows your commitment and also shows your skill in running a successful business. The next one is earning the right to borrow. Generally, borrowing is not a right. Rather, the ability to borrow is an earned privilege. To others' investment, you need to demonstrate, to obtain others' investment, you need to demonstrate your ability to manage your existing debt well and run a profitable business. The next one is showing profitability. Profits are what lenders or investors want to see. Don't let lax management inhibit a healthy bottom line. Understanding and retaining working capital. Experienced business owners know that working capital is critical. On the other hand, working capital is sometimes overlooked or misunderstood by new business owners. As your business grows, the amount of working capital cycling through the business to support operations should grow. Successful business owners stay aware of their working capital needed to grow and sustain their business. The next one is be lean on fixed assets. New business owners sometimes think they need to purchase fixed assets to start or grow a business. Fixed assets consume precious working capital. When acquiring fixed assets, new business owners should consider buying used assets or renting or leasing their assets. Understand your financial statements. Most types of financing require an application process that asks for business financial statements such as your profits and loss, your balance sheet, your cash flow projections. You want to know your financial statements well and be able to discuss them intelligently with a lender. So you want to go for that loan and you want to be able to just speak on your finances, not, rambling or not knowing what to say. So it's good to always be knowledgeable, and that's why earlier when I spoke about your projections, when you're making your revenue projections, it's always good to create your budget and to always visit it and make adjustments and improve on it. So when you do go for that loan or you do go in front of an investor, you know exactly what you're saying and you know exactly what you're talking about, and you have facts and you have real tangible evidence to support it. Next is understanding risk and loan costs per type. Each type of loan carries associated risk and costs. So for example, while a credit card may be easy to use, credit card financing may be a very expensive form of credit. In many cases, a small business loan will be a better form of loan than a credit card. Shop around for the best loan. You may want to start where you already have a personal relationship. So most of us have credit union accounts or maybe National Bank. So if you have a personal account at credit union, start there. You can check out loan guarantees that we will look at later on, which are available at most commercial banks. Get expert advice. You can get mentoring and advice from places like DYBT. Do not rule out banks, especially ones with which you have a good working relationship. Now we're going to look at loans. We're going to look at some steps that you can take to prepare yourself when you're taking a loan or if you're thinking of obtaining a loan for your business. Have a business plan, including a profit plan. The best way to get a loan is to have a solid plan for using the loan. Make sure you have a good, up-to-date business plan which incorporates a profit plan. A profit plan will show how the loan proceeds will be used to increase sales and profitability. Showing a lender a reasonable proposition with a solid repayment plan will help as well. Your plan should include any research you have undertaken to establish your costs and your marketing or sales strategies. The next one is knowing what you can afford. Using the likely loan terms, calculate the amount of funds you will need and the monthly loan payment. Your plan should include a repayment plan with projections that show your ability to make your monthly loan payment. Study your financial statements. As mentioned earlier, a lender will want to see your financial statements. Not only do you need to provide accurate, current, and historical statements, you need to know what your statements say about your business. Be prepared to discuss the details of your statements and explain any issues. Check your credit report. You can obtain a copy of your personal credit report from different places that you have any loans or any other existing loans or payday loans like Fast Cash, or Big Edge. Study your credit reports. Usually when you go for a loan, they give you a generic form that you have to take to different places. When you get back that form, you can make a copy if you want, take a photo of it, but you analyze it, you study it. Make sure it is accurate. Fix any inaccuracies, dispute any inaccuracies, and be prepared to explain any credit issues. Establish collateral options. Be prepared to discuss collateral with lenders. When you are purchasing a fixed asset, the asset is often collateral for the loan. So for example, if you are purchasing a large equipment for manufacturing, that usually serves as collateral for the loan that you are taking. Lines of credit are sometimes unsecured if a business owner can show a strong history of profitability, but it is not uncommon to use personal assets to collateralize a business loan. Show your equity contribution. Lenders usually require an equity contribution for a startup loan or a loan for an expansion project. Research your financial options. You will need to choose between many lenders and many types of loans. Research your options to ensure that you obtain financial or financing from credible sources. So always do your research before you make any decision. Now we're going to look at a list that can get you started in terms of documentation that you may need when you're going into the loan process. First off, your business plan. Most lenders require a business plan that describes your costs and your management and sales strategies. Financial statements, both personal and business and or personal. Lenders generally want to review business finances or business financial statements from past 3 years as well as current statements, and a personal financial statement shows your personal assets, liabilities, and your net worth. Source and equity amount. Business loans usually require the business owner to contribute between 10 and 30% of total project costs in cash or equity. You can include a write-up documenting the amount and source of your equity contribution. Credit reports. Lenders will also order you or give you forms to get credit reports, but it is important you know that they will see, you know what they will see in the report. Make sure you have addressed any credit issues that are contained in the report. Collateral. Lenders usually require collateral. Include options for collateral in your application. Purchase agreements, appraisals, contracts, or estimates. Include purchase agreements to document costs that pertain to your project or to your business. There are different types of loans that we're going to look at now. Business term loans, which establish a set dollar amount to be repaid in installments over 3 or more years, are commonly recommended for purposes such as financing the purchase of equipment or purchasing a vehicle. These loans often are secured by the asset that is purchased. Term loans mean predictable payments for businesses, but unlike lines of credit, a business may have to make a new application if it needs to borrow additional funds. There is also equipment financing, short-term loans, business lines of credit, which provide a convenient way for a business to borrow up to a certain dollar amount and repay it in installments with interest over several years, also presents risk. Business owners should think carefully before borrowing on a line of credit. Consider how and when the business will generate revenue to repay the loan, and make sure you aren't using a short-term financing tool to finance costly long-term investments. There's also personal lines of credit, which I did not include here, such as credit cards, or either your personal credit card or your business credit card guaranteed by you, or home equity lines of credit like your home, which can serve as collateral, are commonly used, but there are risks involved as well. And small business administration loans is generally loans that are offered by agencies or government subsidiaries that not only offer loans at low interest rates, but they also offer business advice, business support, mentoring, and different services for small business owners. I have included a link to the sba.gov website so that you can read up more on small business administration in the US, and also the Dominica Youth Business Trust, which also falls under small business administration. Now let us take a look at startup financing. There are some options for financing a startup business. You have equity, also sweat equity. Equity is simply your money. Many businesses started with savings from their day job, or through the sale of something, sale of an asset. You can launch your business by starting small and reinvesting profits that you make over time to build up your business. Sweat equity means doing it yourself. So owners of startup businesses are often jack of all trades. You put in the hours to cover the many activities of your business rather than hiring somebody or buying it. So for example, Girls with Goals 767, I do everything. I do all my content, I do all my graphics, I do all my video editing, I do everything. So I am using sweat equity to finance my business right now. So I'm a jack of all trades, a Jacqueline of all trades. Family. Some business owners turn to their families for an equity contribution. You can also use capital investors and also crowdfunding to finance your business. Now we just did the different types of financing. We looked at personal lines of credit, business lines of credit, and business term loans. Now here are some helpful tips that I'm going to share with you when it comes to managing your finances, especially within your small business. Separate your business and personal finances. As we said earlier, I would recommend having a separate business account apart from your personal account. Before you can get down to the process of managing your business finances, you need to take an important initial step. You need to separate them from your personal finances. Why is this first step so important? Well, separating your business finances from your personal is essential for organizational and tax reasons. By keeping these finances separate, you have a much easier time managing your bookkeeping and requirements when it comes to business taxes. Perhaps more importantly, however, separating your business and personal finances has legal implications. When you separate your finances in this way, your personal finances are then protected if you were to ever face legal trouble with regard to your business. Next, understanding your business accounting. The next step to managing your small business finances is to understand the basics of small business accounting. Although this may seem like a daunting task, especially if you've never taken an accounting course, there are some basic accounting terms and documents that aren't too difficult to learn. Plus, by reviewing these essentials, you'll have a much better handle on how accounting affects your business finances, and therefore will be in a better place to choose an accounting software and bring in a professional if you need. Terms like gross revenue, expenses, net profit, cash flow, break-even point, balance sheet, income statement, cash flow statement, revenue forecast, and all the other terms associated with accounting. Pay your business taxes. After you've separated your business and personal finances and organized your books, Understanding and fulfilling tax requirements will be the next process you'll want to tackle to manage your business finances. Although taxes are often one of the most cumbersome and confusing parts of small business finance, the consequences for failing to file your state and federal your business taxes are severe. You could lose your business and even face criminal charges. Controlling your credit score. The next step to managing your business finances is understanding and getting a handle on your credit scores. Whether it's a property or equipment lease, a business credit card, or a small business loan, at some point over the life of your business, you need to access credit. Your ability to qualify for business financing of any kind will be dependent upon your personal and business credit rating and history, and both scores are inherently tied to how well or poorly you manage your small business finances. And last but not least, understanding financing options. With the 4 steps I previously mentioned, you'll want to take your business finances to the next level. At some point in the financial trajectory of your business, it's likely that you'll need to seek financing in the form of a small business loan, whether that's to deal with short-term cash flow challenges or to future grow your business. Every type of business loan and lender has different eligibility requirements, including minimum credit scores and annual revenue. Therefore, you'll want to understand the types of loans out there and what you need to qualify, so that you can better organize your business finances from the start of your venture, and this way you'll have a financial goal to work towards as you build. Now, I have included some useful resources that I think will help you to learn more about financial management in your small business. The Organizational Excellence website is a very good resource. They also have a document, I think it's $25 US, that you can purchase that gives you a more in-depth look at managing your finances in your small business and as an entrepreneur. DYBT, the Dominica Youth Business Trust, also has different resources that are very useful, like the Small Business Assistant Facility. There is also Finance Focus. My friend Laura, who has Finance Focus, I have included the link here as well. You can visit her Facebook page. She also has Finance Focus Fridays, I think I said it right, where she gives tips on different financial aspects, personal finances, and how to manage. Great and insightful tips. She does it every Friday, and I will link that below as well. And this season she's focusing on mortgages, so you can check that out tomorrow as well. I'm recording, it's Thursday, so you can check Finance Focus Fridays tomorrow on YouTube. I'm not saying that right, Lulu, I'm sorry. I've also linked the ACCA Global website, which I have a document that speaks on financial management and business success, a guide for entrepreneurs. So it's a PDF version that you can download and that you can read through. It's a simple read. Well, not simple, but it's not a large document. So I've linked that below as well. Also, I have linked 2 PDFs from First Caribbean, Business Banking Guide and Entrepreneur's Guide, and also Business Banking for Small, Medium Businesses. So these are very useful resources that I think will benefit you, and I think would give you a more in-depth look when it comes to financial management with your small business. Get one step closer to reaching your goal. Every day is a new day, a chance to begin to progress and to look forward and work forward towards developing your business goals and obtaining financial freedom that you so desire. You made it to the end, ladies. Congratulations. Thank you again so much for doing volume 3 and for viewing this video course. Like, share, Just share. I appreciate all the love and the support, and I look forward to doing our final volume 4, which would look at some difficulties that women entrepreneurs face, entrepreneurs in general, and available resources and opportunities that are out there for starting a business and for growing your small business. Thank you, and I will see you in volume 4.